Thanks for tuning into today's Talking Point. I'm your host, Niraj Shah. Our guest today is Jeetu Panjabi of EM Capital Advisors. Jeetu, great having you. Thanks for joining in.
Thank you very much. Thank you for hosting me.
You know, it's been a long time. I mean, it's been what, maybe 18 months since we last spoke. Now, Jeetu, when we last spoke, which was probably March or April 2023, right? You were structurally skittish, cyclically constructive. If I got that right.
Absolutely right.
Yeah. What's changed from then and now?
So, you know, if you look back at the last 18 months, we've had a really good 18 months. We've seen liquidity turn positively. We've seen a lot of countries do really well, and markets have been raging. I think we're at an inflection point where this is about to change, right? So we've been in a high return, low volatility market. I think that is just reversed. The next 6 to 9 months, we're going to be in a low return, high volatility market. If you ask me, put a gun to my head and say, what do I think markets do globally next 6 to 9 months? My best guess, zero return, probably plus to minus 5 with huge volatility, huge volatility. Second dimension of the market that's changed is we've been in a top-down market. So like in places like India, you've had themes like railways and defense and a lot of other, you know, short financials, for example. I think the market moves to a bottom-up market. Within the environment, you'll have, within a sector, you'll have 5 companies that do well and 3 that don't. And you're in cherry-picking zone. You've got to go and pick the right company. You've got to make sure the company does it right. And just a top-down call is going to be much tougher to make. So I think this is really what's changed, and you know, you got to change the game where the market changes.
So it seems a bit counterintuitive, Jeetu, in that we're talking of the US economy being in a Goldilocks scenario, India being one of the few, and maybe you were talking about this from a global market perspective, but still, US doing okay. We are at the start of an easing cycle. China has done some moves as well to revive growth. So global GDP may not look as bad over the next 12 months as people might have feared it to be. And you're saying that we will not have returns at all?
Yeah, so I think, well, there are 2 dimensions to it, right? One, I very respectfully disagree that the world is in a good shape. I think US is in a very difficult shape. Okay. We saw the consumer confidence data collapse in the last month's print. We've seen Chinese profit data collapse, 18% fall in Chinese profits after a huge collapse for many years. So my point, and if I look at Europe, if I see the advisories that have come out of the large European autos, everyone is saying we were expecting 2% growth, now we're going to be down 5 or 7 or 9%. And 2, the profits are going to collapse. I don't think this is in market horizons. If I see what the markets are saying, I think there's a disagreement between what the markets are saying and where I think the world is heading. It's just where I'm coming in and saying, I think the global economy looks really, really difficult. Data will show you in the next 6 months that things don't look good. The rate cut was clearly needed. Maybe 50 is not enough. Maybe you need another 50 by December. I think you saw the Swiss National Bank yesterday cut. I think you're going to have a synchronous rate cut cycle globally. Including India by the end of the year. And I think you're at a point where all this is needed. Now, why do you cut? Because things are bad. Things aren't good. And you're going to see it in the numbers. So on one side, you'll have fundamental numbers going down. The other side, you'll have liquidity going up. There's a push and a pull. Markets are overvalued globally, especially the US. And you'll see the push and the pull result in high volatility. And flat markets is my best guess.
Okay, so so I completely agree, but what I meant to ask was that we know that the world growth numbers, save for maybe US, and you said you disagree, but let's assume that some people believe that that number is still looking okay, and a few other markets looking okay. So growth is, I'm not disputing on that on growth, but you don't believe that markets can still deliver positive returns in an easing cycle. You don't think that will happen. Central banks have moved the markets since the COVID lows. You don't think?
So if the valuations were not where they were,
okay,
I would agree with you. I don't think the valuations, our models, and these are 30, 40-year models, are saying valuations are stretched. Can liquidity still push it up? Can there be other stuff happening? Possible. But I think it's going to be a lot tougher. And the numbers are just not going to look good. They're just not pricing in what the real world is doing. In my view, the last 2 months, the high frequency data in the last 2 months is much worse, especially in Europe, than most people expect.
Got it. And which is where I'll invoke in the second half of our conversation, what does it mean for Indian companies which are outward facing versus domestic facing as well? And can India be slightly different? But just before I come to India, Jeetu, a word on China, because I know you look at that very, very closely, the data coming from there and the implications thereof. China has made some serious changes to what it has been doing for the last 12 months, in the last 2 months, and especially in the last few days as well. What do you make of all the moves that have happened in China and the resultant implications on commodities and on other economies, if you will?
Okay, so it's a great question. In the way I've been watching China for almost 24, 25 years as an analyst and been continuing to do that. The last 7 weeks, China's completely changed tack, completely.
Please explain.
And I don't think some markets have recognized it, but I think the policy side needs to recognize it too. So let me explain, right? 18 months, March 23 through July 24, China followed a policy of easy FX and tight money. So essentially, they let the currency go down and they neutralized the pain on inflation and anything else by using monetary policy. Since July 26th or 27, the FX appreciation game started. The Chinese yuan is more than 4.5% up since. And this is a big change, a huge change to do in 7 weeks. And what you normally do is when you have an FX tightening, you do a monetary easing. And they started the monetary easing last week, right? So you can see two legs happening, the entire change happening. I see other countries haven't done the same. So do I think India's behind the curve on this? Yes. Do I think Governor Das is going to look at this and say, yes, he needs to be following the same trajectory? I think so.
Okay. So, okay, let me just squeeze in that question and then I come back to the Chinese impact. But you reckon that by virtue of the fact that US easing cycle has begun, and that is to a lot of people a bit of a trigger as well for India, and the fact that China has done this leads to an October policy change?
I don't know whether it's October or December. In my humble opinion, you need to ease liquidity first before you cut rates. Okay, so all the interventions in the FX markets needs to pause. You need the rupee to appreciate at least 1% or 2%, and then you need because you have a problem of deposits in the system. So unless liquidity flows into the system and flushes the system, a rate cut might create other problems, and you need to do that. But essentially, if we're sitting 6 months from now, there has to be a significant easing cycle, and the RBI knows what best to do. You know, first, second, third, all that, they understand that well.
I'm sure they do. Okay, Jeetu, coming back to China, sorry, because I want to understand that. Now that there is a move that has happened, and people have been crying for months about how China is not making any kind of policy move, they've made a move. There has been a resultant impact in that the Chinese markets have done well, metals and commodities have done well, save for crude, but industrial metals have done really well. What happens next? And now that the first signs of the move have come, there might be more things that might happen, assuming that those happen as well. How do you see Chinese markets? How do you see commodity markets? And the resultant impact of what China does in other markets happening over the next 2 months?
Okay, so let's first understand what's the problem in China. A lot of the problems in China are structural, right? You have a policy leadership that has issues of its own. There are battles within that. Two, the real estate sector has huge oversupply. Digesting that and cleaning up the system, and the deflation that's ensuing is a significant structural problem. It's going to take 5-7 years to solve. And the third, the collateral damage on the household balance sheet and confidence isn't going away. So the point is, and then on top of that, you have an export chain, in my view, which is going to see much more pressure in the coming quarter or two. And the only way you can do is throw more money into the system, create more domestic demand, and try and neutralize that pain. Now, that's what I can see they're visibly doing, right? A 4% move on the FX, plus monetary easing, and they hopefully kind of buffer the downturn, the pressure on the downside, right? What how does this play out on your commodity markets? In my view, the demand is still very, very weak. Is the real estate sector going to structurally turn? Answers no. Is there a big upside there? Answers no. Is commodities going to be exported the hell out of globally? Yes, they're doing it. Is the world in great shape to absorb that? I don't think so. So this commodity move is a financial market move, in my humble opinion. Do I see volume changing in a big hurry? I don't think so. And it just wobbles around, and which is where I come into the high volatility market zone, right? So all of this, the pushes and the pulls of liquidity and real demand are going to create high volatility. Do we end at the same price 6 or 9 months from now? Very possible.
Very possible. Okay. The only antidote to this, or the antithesis to this, is if liquidity really picks up, right? And there are, I mean, one argument that I got at the recent JP Morgan conference, which a few people made, Jeetu, was this, that there are funds which are sitting pretty at the 5.25 rate or higher than that in fixed income US treasuries, which as the rate easing cycle begins, will move searching for greener pastures because they don't want that number. They want a higher number. They don't want the 4% number or 4.5% number or even a 4.75% number. And if that liquidity were to find its way into emerging markets, as you could argue traditionally has happened, could that keep markets afloat or maybe even more inflated?
It's a very, so when you, typical rate cut cycles, money is going to come into EM, okay? We're no debating that. Does that happen this time around? I think so. Is that what creates the positivity? Yes. Are domestic flows going to create positivity? Yes. Is the supply side heavy? Yes. And but valuations are stretched. So at some point, someone's going to walk. And so can markets be 5-7% higher 6 or 9 months out? Absolutely. But do you kind of see the geopolitical side just cracking globally? Is that a possible risk factor where the winds change and people get scared and run? Possible, I don't know. So I'm saying there are a lot of factors.
Could the reverse happen, Jeetu? If there's a Trump presidency, if there is a pause in the wars across, right? Because the world has learned to live with geopolitical conflicts. I mean, the crude behavior is a sign that geopolitics doesn't seem to be worrying the world anymore.
So your words to God's ears, I hope. I think, seeing such large human loss, human lives lost is not good. Markets aside, I think, yes, markets would be pleasantly surprised if that happens. But again, all my models are saying the valuations are stretched, businesses are not doing well. In fact, I'll just make one point. There are 3 places in the world in a very weak global economic environment that seem to be doing well, right? Japan, India, and Spain. Do I understand exactly what's going on in Spain? Not enough. But the point is there are 3 places out of 43 markets in our models that look decent, and the rest are in really, really bad shape. In my view, there are air pockets not yet hit the results data, and we're going to see really lousy numbers going forward.
Yeah, that's the other thing, though. And just before we come to that, Jeetu, just wondering, so is this where you are at? For lack of a better word, loggerheads with the common market wisdom that when the numbers start coming in, the world will wake up and smell coffee?
I think.
Or is it somewhere else?
No, I think this is one big piece, right? The fact that valuations are high and the numbers are going to be much lower than what markets think. I think that's one area where I disagree with the markets. Can liquidity prove me wrong? Absolutely. Am I going to be humble enough to change my view and say, yes, there's an economic cycle that bottoms in March 25 and turns, and we're going to be looking great in December 25, and I'm going to price it through liquidity now? Well, I could be wrong, and I'm happy to be proved wrong in that scenario. But you need to understand that this is what the milestones look like. You can jump a few milestones and go out 18 months out, but I'm not so aggressive. I'm a little cautious right now, saying we've had a good run. Year-to-date numbers in the US 16%. Right, normative numbers are 8-9%, and with the data not looking that good. Every rate cut cycle is a reason because economy is not good, companies are not doing well, the consumers are hurting, and you need to cut rates, and that's what's happening.
So how do you play India in such a scenario then?
So in my view, India's had a phenomenal run. I mean, watching markets for 30 years, this is, where there's huge froth in a lot of small parts of the market, the SME market and other parts of the markets are really frothy, right? As I see it. How do you play this? In my view, the one big difference you make is global cyclicals. You need to be extremely cautious, and domestic-driven parts of the market, you need to be constructive. That's one big thesis. Second thing, what do I expect? I think liquidity gets much better. Now, what was the malaise of the banking system for the last 12 months? Liquidity was really tight. When that eases, there's more deposits that go into the banking system. The banking system starts lubricating faster. Growth comes back. Our banks have been the cheapest they've been in a long, long time. So do I think banks do well over the next 6-9 months? Yes. And I think the domestic side still has some legs to it. Hopefully that turn, but I'd be very, very cautious on the global cyclicals.
Okay. Before I come to global cyclicals, because you mentioned banks, is the investing, I know Jeetu Panjabi is a guy who invests for growth. I'm hearing a Jeetu Panjabi talk about banks from a valuation perspective, not from a growth perspective. Why is that?
No, I think, so when I see, also, let me, that hasn't changed. The fundamental growth investing hasn't changed. We're seeing huge opportunity in a lot of sectors where there's entrepreneurship raging, okay? You see the air conditioning, manufacturing with PLIs, you see the EMS stuff, you see a lot of smaller companies doing, companies doing dredging, companies doing other stuff. All of that continues, and that's driven by entrepreneurship, that's driven by energy, that's driven by domestic demand, that's driven by policy being supportive, and that's driven by an Indian economy growing and doing well. None of that changes.
Got it.
Okay? What I'm saying is, when you're looking from a big asset allocation standpoint and thinking, what do? I think the easy one is financials.
Okay, yeah. Well, the low-hanging fruit, the low ball, if you will. Okay,
yeah.
Great. Okay. Do you sense, that the financials, if the financials have to make money, the money will be made by valuation repricing as opposed to growth? Because if everything that we're talking about is something that even entrepreneurs identify with, then the much awaited private Capex cycle might just take that much longer to kickstart. In fact, also on that point, Jeetu, would love to understand from you. There's a lot of voices that we picked up at the JP Morgan Investor Conference again, that if indeed tariffs come about, then China dumps its goods, which it was sending to US, to Europe, etc., and stuff like that. But if that gets curtailed, it goes into the EM and the Asia Pac, and it deflates the end product prices in areas where Indian manufacturers might have wanted to step up capacity. So is the private Capex cycle under a bit of question mark in a very near term?
So, when you look at the macro data and try to look for the private Capex cycle, the answer is what you're saying.
Okay.
It's coming, not yet come.
Yeah, exactly.
But if I go down to the companies we're looking at closely and say, what are they doing in terms of Capex? Are they putting money on the table? The answer is yes. Are they putting it in very Capex intensive industries? The answer is no. Are they doing it where India has a demand side and not enough of a supply side to be met? The answer is yes. So when I look at the macro data, I kind of say, oh, the Capex cycle is still not here. When I go and see the operating companies, they're saying, oh, we're adding capacity. We need capacity. We're adding capacity. Do you think the global cyclical commodities, which are fungible globally like steel and other stuff, are you going to see pressure points there? I think there are pressure points, but India's adding capacity there too. So the answer is somewhere in between, that the macro data is showing you that it's taking some time, but certain businesses and certain industries, it's happening as of yesterday.
Okay. Okay. Which themes? Because I heard you say that dredging might be some possible, but where is it that you see business confidence being very high or high?
So, you look at the manufacturing side, okay?
Very wide bucket.
You look at the air conditioning and electronic manufacturing side.
Okay.
10 years ago, how many ODUs were made out of India from China? India, the market size was 20 million units. One factory in China was 20 million units.
Right.
right? Today you're seeing the capacity in India has come up to 30, 35 million units. It's all happened in 6, 7 years. Are you going to see that scale up? Did you see that scale up coming? I don't think so.
Right.
Was there a bit of government help? Yes. Were there PLIs in place? Yes. Do I see each of the large international OEs taking up PLI and setting up manufacturing here? Yes. Are there suppliers into that manufacturing chain? Yes. Are there opportunities to find and invest in alongside? Absolutely. And that's what I'm saying. So there are chains, there are food chains in the industrial side and manufacturing side where we're seeing huge opportunity.
Got it.
Even in the solar side, right? So yeah, the polysilicon companies, the top 2, 3 companies in polysilicon in China are hurting. Their profits are really hurt. They're trading at 0.2 times, 0.3 times book value. It's like death over there, right? And here you're seeing a completely opposite picture. But are you seeing Indian companies who are executing on the Indian solar dream and growing at 100, 150% per annum? Are they doing well? Yes. So you've kind of found that the government has helped ensure these guys stay alive, do well, use the pain in China, get the stuff in, and then slowly integrate and build greater capacities. It's going to take some time, but it's happening.
Okay, so manufacturing is your favorite. Well, just one quick question before the last couple of questions maybe. One is, I heard you say that global cyclicals are an avoid. What about IT services? How do they fare?
You know, I don't have a strong view. When I see the advisories coming out of the big guys globally, it kind of is nervous. When I see the hiring data coming out of the Googles and Amazons and Facebooks, it's telling you things are hurting. Have you seen a change over there? So once they start hiring, you know that this scale is going to get faster. But I think people are nervous, and I'm supportive of that, saying, let's wait, let the global economy turn. It's going to take 6 or 9 months. My starting point is the world is not in good shape. The data is going to show it in the next 3, 6 months. Once you're somewhere near the bottom, you have a business cycle bottom, you have a market cycle bottom, that'll be the time to get in.
But the bottoms now could be a lot quicker to arrive at. You believe this could happen in the next 6 to 9 months, and then the cyclical recovery could come back as well?
Let's wait for the data. I mean, at this point, I can see there's downside that's not priced in. Let's wait for a bit of pain, and then we talk about the upside after that.
One last question. Can the pain in India be exacerbated by the valuations that we are trading at, or is the wall of liquidity going to ensure that the dips are not so large?
I'd lean on the latter. The fact that there's 2 lakh crores of liquidity with the mutual funds, there's a lot of money coming in every day. Is that going to buffer some of the pain if possible? Yes. But when, let's say, a company reports a 50% fall in earnings, that company's toast. So I'm saying, I'm going back to saying this is a bottom-up market over the next 6 to 9 months. Focus on your companies. There'll be some guys who do really well, some guys do really badly. Focus on your companies. Focus on who's doing well within a sector as well.
Perfect.
Execution's going to be tougher, and be careful about certain sectors.
Okay, got it. Jeetu, thank you so much for taking the time out and being with us on Talking Point today.
Appreciate it. Thank you.
The pleasure was ours, viewers. Thanks for tuning in.